Okay, so good evening, class. In the last class, we have done with methods of new issue. We talked about public issue. We talked about the types of public issue, that is IPO, initial public offer. We talked about FPO. We talked about offer for sale. So in the last class, in the last part, we are talking about private placement. So what was private placement? When shares are issued other than to publics, means when shares are issued to people other than publics. So who are they? To whom the shares are being issued? The shares are being issued to QIBs, that is qualified institutional buyers. When shares are issued to the qualified institutional buyers, when shares are issued to the QIBs, that is the qualified institutional buyer, it is known as qualified institutional placement. Qualified institutional placement, right? It is known as qualified institutional placement. When shares are issued to the promoters, to the directors, to the KMPs, when the shares are issued to the promoters, to the directors, to the KMPs, it is known as what? Preferential issue. Preferential issue. And when shares are issued to the employees, there are two types. There are two types. One is what? One is the employee. One is the employee stock option scheme, that is Esos. Another is the employee stock purchase scheme, that is ESPS. Clear? Now what is the difference between this Esos and ESPS? Now Esos is giving what? Employee stock option. Just read out the name. What is it saying? Employee stock option. Employee stock option. And what is this employee? Next one, ESPS. It is talking about employee stock purchase. One is option, one is purchase. So the difference lies here only. What is the difference? The company issues shares to the employees, right? We are talking about issue, public issue, type of public issue, where in this case it is happening what? That the company is issuing shares to people other than the public. To whom? To the employees, or in case to the promoters, directors, KMPs, or to the QIBs, right? In case of employees, when shares are being issued, they are being issued in two different schemes. One is employee stock option scheme, another is employee stock purchase scheme. So what is the difference? The difference is that, first let me talk about to whom these schemes are being given to. They are given to permanent employees. They are given to permanent employees. Okay. Whether the employee residing in India or outside India, but they are permanent employee of the company. So if the employee is residing in India or outside India, that doesn't matter. It's given to permanent employees of the company. It is given to both whole-time and part-time director. Both whole-time and part-time director. It is given to both whole-time and part-time director. Okay, of the company or the company's subsidiary company. Okay, now we all know what is subsidiary company. There is a holding company. If you remember, you have done in company law, and the holding company, if holds a company, the company held by the holding company is known as the subsidiary company. So this is a subsidiary, what I wrote of subsidiary. This is a subsidiary company. Now what is subsidiary company? Now for this you need to do company law class if you don't remember what is subsidiary company. So holding company, the company held by the holding company is known as a subsidiary company. Okay. More than 50% of the shareholding. Remember, a company which holds more than 50% of the shareholders in another company, that company is known as a holding company, and whose shares are being held is known as the subsidiary company. Mone poche? It's company law. Okay. So to whom these schemes are being given? To permanent employees, whether residing in India or outside India, and to directors, whether whole-time or part-time, of the company, directors of that company or that company's holding company, or subsidiary company. Clear? So these, to them it is given, to them the options are being given, right? Okay. So what is the difference now? The difference is that whenever the company issues shares to the employees, what is happening? The thing is that there is a vesting period. What? There is a vesting period. মানে কি, আমি আজকে আমার এমপ্লয়িজদের নামে কিছু শেয়ার্স ইস্যু করলাম, বাট এই এমপ্লয়িগুলো এই শেয়ার্সগুলোকে অ্যাভেল করতে পারবে বা পারচেজ করতে পারবে তখনই যখন তাদের ভেস্টিং পিরিয়ডটা ওভার হয়ে গেছে। না, হোয়াট ইজ দিস ভেস্টিং পিরিয়ড? ভেস্টিং পিরিয়ড মিন্স there is a gap of 1 year given from the time of issue. A gap of 1 year is given from the time of issue. That is called the vesting period. There is a difference between, there is a gap, minimum 1 year gap between the grant of such option and between the use of such option. Okay, means the grant date, between the grant date and between the vest date, there should be a minimum gap of 1 year. This is a rule which is needed to be followed. So the difference between Esos and ESPS is that in case of Esos, after this 1 year, the employee is given the option that if you wish, you could buy, and if you do not wish, you do not have to buy. But in case of employee stock purchase scheme, there is no option but mandatory for the employee to buy the shares of the company. Is it clear? So this is the difference. Also, you know what? Whenever the shares get allotted to the employees, for 1 year, the employees cannot sell those shares. So there are several options, there are several rules regarding this Esos and ESPS. Clear? So whenever the company is coming out with private placement, that is issuing shares to people other than public, and when they are issuing to employees, they issues in two schemes. One is employee stock option scheme, one is employee stock purchase scheme. Both these are issued to whom? Both of this scheme could be issued to permanent employees, whether working in India or outside India, a director, full-time or part-time of the company or its holding company or subsidiary company. Okay, to them this can be issued. And what is the difference? The difference is that there is a 1 year gap between the grant date and the vest date. Whenever the date when the company is granting this, it is called the grant date, and vesting means when it goes into the hands of the employees, that is the vest date. There must be a minimum gap of 1 year. And after this 1 year, on the vest date, in case of ESOS, employee stock option scheme, an option is given to the employee that if the employee wishes, then only the employee can buy. In case of employee stock purchase scheme, it is said that it is mandatory to purchase. There is no option given. So this is the difference. Is it clear? Is it clear, students? Done. And also what I told, that after allotment of the shares, suppose after allotting the shares to the employees within 1 year, the employee cannot sell those shares also. So this is an option, this is a rules and regulations regarding the issue of shares to employees. These are the rules which are needed to be followed. Clear? So in private placement, when we are issuing shares to qualified institutional buyers, in private placement, what? When we are issuing shares to qualified institutional buyers, it is called what? Qualified institutional placement. When we are issuing shares to promoters, directors and KMP, it is called preferential issue. When we are issuing shares to employees, there are two schemes. One is the employee stock option scheme, another is the employee stock purchase scheme. In case of employee stock option scheme, an option is given to the employee to purchase or not purchase based on the preference. But in case of employee stock purchase scheme, there is no such option given. It's mandatory for the employee to purchase the shares. Clear? Is it clear? Okay. Now, you all are thinking, ma'am is talking about QIBs, qualified institutional buyers. But who are these qualified institutional buyers? Shares are issued to QIBs. I've understood that QIBs, qualified institutional buyers, I've understood the full form. But why ma'am is not talking about who are these QIBs? Who are these QIBs? Now ma'am will talk about QIBs. Now QIBs are nothing but they are high net worth investors. They have a huge capability of investment. Their risk appetite, their investment appetite is high. They have huge money to invest. They are QIBs. Now few examples of QIBs I am giving. Mutual fund, foreign venture capitals, insurance company registered under IRDA, means Insurance Regulatory and Development Authority. Insurance companies, scheduled commercial banks, public financial institutions, these are QIBs. Having their investment appetite is high. They could invest too much. They have the high fund to invest. They have huge fund to invest. There are certain insurance funds which are managed and set up by Army, managed by Department of Post. They are QIBs. When companies issue shares to QIBs, it is known as qualified institutional placement. Is it clear? These are QIBs. They are high net worth investors. In one word, we can say they are high net worth investors. They have a huge investment appetite. They have huge money to invest. In precise, they have huge money to invest. Is it clear? So these are the QIBs. Now we'll move on to the next part. We talked about public issue, right? We talked about public issue, that when company comes out with new issue of shares, that is, new issue means when the company shares are issued for the first time. Okay, there is IPO, there is a FPO. For IPO means what? When the company for the first time is issuing shares to the public. FPO, then afterwards when the company is continuing the share issue thing, it is called FPO. And offer for sale we have talked. Now the next thing that we will talk is public issue. Whether there are certain norms, regulation regarding this public issue. Yes, there are certain norms that is required to be followed to bring this public issue. It is not that easy that if I'm one fine morning I woke up and I thought, okay, today I will issue shares to the public. No, it's not like that. There are certain norms which are needed to be followed, and these norms are separate for listed companies and unlisted companies. এই norms, rules and regulations গুলো separate for listed আর unlisted company. একদিন ঘুম থেকে উঠে হঠাৎ আমি ভাবলাম আমি শেয়ার ইস্যু করে দেবো পাবলিককে, that's not possible. Okay dear, so let's just see what are the norms. I don't know whether these norms will be given in your books or not, and I have actually missed it in my notes also. Have not given those, but let's see. Okay, just check your book if those norms are given. Okay, so now today we will talk about the eligibility norms of public issue. Eligibility norms of public issue. First we will talk about unlisted company, not the listed ones. First we'll talk about unlisted company. Now if unlisted company wants to come out with public issue, they need to fulfill 5 eligibility norms. They need to fulfill how many? 5 eligibility norms. So what are these 5 eligibility norms? Nothing. Very simple. The company must have a net tangible asset. Net tangible, not intangible. Net tangible asset of at least 3 crores, in each of the preceding 3 full years, of which, is it visible? Okay, of which not more than 50% is held in monetary assets. What I'm telling? Eligibility norms of public issue. What is this? First eligibility norm of public issue in case of unlisted company. That is what? If unlisted company wants to come out with public issue of shares, the company needs to have net tangible asset. নেট ট্যাঞ্জিবল অ্যাসেট কত টাকার? মিনিমাম 3 কোটি টাকার। In each of the 3 preceding full year, means what is this full year? Means ধর এই বছরে কোম্পানি 2021 কোম্পানি is wanting to bring public issue. So in 2020, 2019 and 2018, a last immediately preceding 3 years, এই লাস্ট 3 বছরে কোম্পানির নেট ট্যাঞ্জিবল অ্যাসেট শুড বি 3 crores অ্যান্ড ফুল ইয়ার মানে কি এভরি ডে দ্য ট্যাঞ্জিবল অ্যাসেট শুড বি অ্যাটলিস্ট 3 crores। এমন যদি কোনো একটা সিঙ্গেল ডে হয় যেদিন নেট ট্যাঞ্জিবল অ্যাসেট কমে গিয়ে 3 কোটির নিচে চলে গেছে, দ্য কোম্পানি ইজ নট এলিজিবল। ইজ ইট ক্লিয়ার? তাই জন্য কথাটা বলেছে কোম্পানিজ নেট ট্যাঞ্জিবল অ্যাসেট অফ অ্যাটলিস্ট 3 crores in each of the preceding 3 full year. Each and every day of that 3 year will be counted. যে every dayতে at least 3 কোটি টাকা আছে কিনা net tangible asset. Each day will be counted, and in this net tangible asset, not more than ম্যাক্সিমাম তুমি 50% মনিটারি অ্যাসেটে রাখতে পারো। তোমার নেট ট্যাঞ্জিবল অ্যাসেটের মধ্যে ম্যাক্সিমাম 50% মনিটারি অ্যাসেটে তুমি ইনভেস্ট করতে পারো না। হোয়াট ইজ দিস মনিটারি অ্যাসেট? মনিটারি অ্যাসেট মিনস দ্য অ্যাসেট উইচ কুড বি ইজিলি কনভার্টেড ইন্টু ক্যাশ। তারা ক্যাশ ইনভেস্টমেন্ট খুব ইজিলি যেটা আমি ক্যাশে কনভার্ট করে দিতে পারবো। দিজ আর মনিটারি অ্যাসেট। তো তোমার যেটা নেট ট্যাঞ্জিবল অ্যাসেট আছে, সেই নেট ট্যাঞ্জিবল অ্যাসেটের ম্যাক্সিমাম তুমি 50% মনিটারি অ্যাসেটে রাখতে পারো, তার বেশি নয়। So first condition is what? Company's net tangible asset should be minimum at least 3 crores in each of the preceding 3 full years, and out of which not more than 50% should be held in monetary asset. Clear? Is it clear? So this is number 1 for unlisted company. Now coming to number 2 condition. Number 2 is what? Minimum average pre-tax operating profit of rupees 15 crore during the 3 most profitable year out of the immediately preceding 5 years. Just simple. The average pre-tax operating means before tax. The average before tax operating profit of the company must be minimum 15 crores. During which years? During the 3 most profitable year. Means 2021 যদি I want to come out with public issue in 2020, 2019, 2018, 2017, 1 2 3 4 2016. Suppose 50, 100, 120, 40, 160. What? Just understand. কি বলছে? Minimum average pre-tax operating profit of 15 crore during the 3 most profitable years out of the immediately preceding 5 years. So 2021 preceding 5 years কোনগুলো? 2020, 19, 18, 17. These are the preceding 5 years. Most profitable year কোনগুলো? Suppose these are the profits earned during those 5 years. The most profitable years কোনগুলো? This one, 2017, 2018 and 2020. So we have to check the minimum average pre-tax operating profit of these years. It must be 15 crore. Minimum average pre-tax operating profit of 15 crore during the 3 most profitable years out of the preceding 5 years. So what are these 5 years? 2020, 2019, 18, 17 and 16. Out of these 5 years, the most profitable 3 years is 17, 18 and 20. So we have to check the average pre-tax operating profit of these 3 most profitable years out of the preceding 5 years. Is it clear? This is number 2. Number 3. Moving on to the next. Number 3. Company has a net worth of at least 1 crore in each of the preceding 3 full years. Full years again. 3 full years. Net worth of minimum 1 crore in each of the preceding 3 full years. It's easy. Means 2021, if you are coming with an issue in 2020, 2019, 2018, the net worth must be minimum 1 crore. 1 crore in each day, every day of this 3 years. That is why we are talking of saying 3 full years. Clear? Number 4. Now if you are talking about number 4, number 4 is what? Number 4 is that the proposed issue plus the previous issues made in the same financial year, must not exceed 5 times of its pre-issue net worth as per the audited balance sheet of last financial year. The proposed issue means whatever company has given proposal to issue. It has not been issued yet, but company has proposed that I will come out with this issue. If the proposed and the previous issue means in the same year, if the proposed in the same year, the proposed and the previous issue cannot exceed, the total of this two cannot exceed 5 times of with pre-issue net worth, means the net worth before issue, whatever is your net worth, make it 5 times. The proposed and previous issue cannot exceed 5 times. Suppose your pre-issue net worth was 20. So make it 5 times into 5 means 100. So your proposed and previous issue cannot exceed this 100. It could be equal to 100, but it cannot be 200. No. It can be equal to 100, but it cannot be 200. No. So the 5 times, calculate the 5 times of pre-issue net worth, your pre-issue net worth. Then the proposed and previous issue, calculate it. If the proposed and previous issue is exceeding it, then you are not eligible. If it is equal to or below it, then you are eligible. Okay? Of the last year, you have to check this for the last year. Okay? Of 2020, you have to check this. If you are wishing to coming with a publication 2021. And the last one, number 5. If the company has changed its name in the last 1 year. If the company has changed its name in the last 1 year, ki koreche company naam change kore diche. Okay. Then at least 50% of the revenue. Then at least 50% of the revenue for the preceding 1 full year. For the preceding 1 full year. Preceding 1 full year is earned by the company from the activity suggested by that name. Don't panic, it's easy, it's easy. So কি বলছে in the last 1 year, যদি in the last 1 year company নামটা চেঞ্জ করে দিচ্ছে. Suppose a manufacturing company নাম চেঞ্জ করে দিল. So you need to see that in whichever year you are coming with public issue, in the last year you need to see that if there is a name change, then whether in that year at least 50% of the revenue has been derived from the activity that the name suggests. That is, if it was a manufacturing company, means the primary activity is manufacturing, so at least 50% of the revenue should be derived from manufacturing only and not from any other thing. This we need to check. Is it clear? So these are the 5 conditions that unlisted company needs to follow if unlisted company wants to come out with public issue. Now, number one was very easy. Net tangible asset, you have to check, of the 3 preceding full year must be at least 3 crores, and out of which not more than 50% should be invested in monetary assets. Number two was what? Number two was minimum average pre-tax operating profit in the 3 most profitable years out of the preceding 5 years should be at least 15 crore. Next, number 3, net worth of minimum 1 crore in the 3 preceding full years. This was easy. Number 4 was proposed and previous issue. Whatever issue the company have already made and whatever issue the company is proposing, যে করব আমি আর যেগুলো করে নিয়েছি সেগুলো একসাথে করে, it must not exceed together, it must not exceed 5 times of the pre-issue net worth of the company. And if in the last 1 year company have changed its name, then at least 50% of the revenue should be generated from the activity suggested by the name. So these are the 5 conditions that an unlisted company needs to follow if it wants to come out with public issue. Now, in case of listed company, only the conditions 4 and 5 if is followed, then listed company can easily come out with public issue. So for unlisted it was 5 options, means 5 norms, and for listed is the last 2 one, that is the proposed and previous issue must not exceed 5 times of the pre-issue net worth, and 5th one, that is if the company has changed its name in the last 1 year, at least 50% of the revenue should be generated from the activity suggested by the name. So for listed company it is 2 norms, and for unlisted it is 5 norms if they want to come out with public issue. Now you can ask me, or you are thinking that if suppose unlisted company fails to fulfill the 5 condition and listed company fails to fulfill its 2 condition. Unlisted company fails to fulfill the 5 condition and listed company fails to fulfill the 2 condition. Then what is the way of bringing out public issue or coming out with public issue? Then also the company can make public issue, provided that the entire issue should be through a mechanism which is known as book building mechanism. The entire thing should be through a mechanism which is known as book building mechanism. The entire thing should be through a mechanism which is known as a book building mechanism, and minimum 75% of the issue size must be subscribed by QIBs. Means whatever issue the company is bringing, whatever amount issue, suppose 100, the issue size is 100, minimum 75% of 100 should be subscribed by QIBs. If you are failing to fulfill the 5 condition in case of unlisted company, and if you are failing to fulfill the 2 condition in case of listed company, then also both the companies can come out with public issue, provided that the entire issue is brought through a mechanism which is known as book building mechanism, and minimum 75% of the issue size must be subscribed by QIBs, qualified institutional buyers. Is it clear? So this is the concept of public issue. These are the types of public issue. Now in the next class we will start with what is book building mechanism. We'll talk about green shoe option. Okay, in the next class we'll talk about book building mechanism. We will talk about green shoe option. We'll talk about a green shoe option, and if time permits we will talk about a few other things. Okay, in the next class, and in the next 2 classes I'm hoping that I will complete the capital market, and I will quickly get into money market, and will try to complete the syllabus. I will try to complete the syllabus because this opening of college, closing of college, again opening, again closing, these have completely disturbed the pattern, everything. Anyways, so in the next class we will continue with book building. So thank you class.